Cool. So now that you know what to buy because you built a plan and you know where to buy because you've learned how to find the best property markets in Australia, we're going to learn how to buy. So I'm going to show you how to effectively acquire those properties. So this part has a few steps, and the first step is going to be to figure out what your purchasing structure looks like. And I have done a video where I go into more detail about this. So if you want the link, please drop a comment below or send me a DM. I also want to preface this by saying that none of this is either financial or legal advice. And please, to figure out what's the best structure for you, have a chat with your broker and your accountant or lawyer. However, this is what most of our clients do. First, they start buying trust at some point, and this is by the second or third property. And they do this to avoid hitting a borrowing capacity wall because, as a rule of thumb, in a trust, you will be able to borrow as much as that trust can service. And in your personal name, you'll be able to borrow as much as your theoretical borrowing capacity says, basically. In terms of the lending, loan to value ratio, most of our investors do between 88 to 90% loans, and they do this to leverage their money because once you control a property, regardless the LVR, you get to reap all the benefits of the property. You get all the growth, so the least amount of money you put down to purchase a property, the higher the return is going to be. And you can put that extra money into another property. In terms of the repayments, usually most of our investors do interest only as opposed to principal and interest. Since you're not paying principal, your cash flow position in your portfolio improves, de-risking your cash flow position, increasing the buffer, and allowing you to hold more property and grow your portfolio faster and safer. Also, from a serviceability standpoint, a lot of lenders in Australia see this as a good thing, especially if it's coupled with trusts. Now, once we know how our structuring looks like, we are ready to go and find that property. So, first thing we want to do in our due diligence is shortlist. So, basically, make a list of good candidates to be the property that we're going to purchase. In order to do this, we either go online to pages like realestate.com.au or Domain, or build relationships with agents on the ground to have access to off-market opportunities, which of course takes some time and effort to build, but you can leverage from us those relationships that we've built already. The next thing you want to do is pick up your phone and make some calls. So you want to call the selling agent and at least one local property manager that you have built a relationship with. And the kind of information you want to get from these people is things like current tenancy, appraised rent, other buyer's interests, holding costs, and other things like how's the location on a street level and such. Once you have this information, what you want to do is calculate the cash flow. So you would use some sort of spreadsheet. This is an extract of a bigger spreadsheet that we use. And you want to calculate how much cash is coming in and how much cash is coming out. Essentially, income minus expenses. So the income is the rental income, basically. And the cash out or the expenses are things like loan interest, principal repayments, if you have them, property management fee, insurance, rates, and an allocation for maintenance. So once you do one minus the other, you have the net cash flow for year one, which is usually the worst year because then rents are usually go up. And with a spreadsheet like ours, you can do many other calculations. You can put in the loan conditions. You can put in all the estimates of the purchasing cost. You can put growth projections, cash flow projections, and everything. Everything is included here and automatically calculated. The next thing you want to do is to determine the estimated value of the property. So then you can determine the price that you're willing to pay. And in order to do this, you'll need to do something that is called a CMA or comparative market analysis, something like this, where you want to compare at least 5 to 10 properties that have been recently sold or are for sale that are really, really similar to a property that you're trying to buy to then estimate the value of the property. And for example, in this case, it's just like 2 properties that have been used as a comparable, and the estimated price is somewhere between 415 and 430 or whatever. Now, up to here, all of this is desktop due diligence. The next step would be to actually get a physical pre-purchase inspection. And in order to do this, either you go physically yourself, but you probably live far away. So you either pay someone to go and do this inspection for you, or leverage these property manager relationships that you have built to get them to do that pre-purchase inspection for you for free. Usually this is quite symbiotic, because what they do is they do it for free, and then they have the opportunity to pitch their property management service to you once you secure the property. And usually you would want to go with them anyway if they're doing all that work for you. What you want to do is give them a really detailed checklist of all the things you want them to check in the property. And these are just some examples of things that we get them to check. The last step would be to actually secure the property. So the first step of securing the property would be to negotiate. So what you want to do is find out what will get the deal done. So what things are important to the seller or the owner? Well, it could be price, but it could also be ease and speed of transaction, no or shorter finance clause. It could be other professional, personal, or financial reasons. You never know. So find out what's actually important to the other party and what's going to get the deal done. And especially if those are things that you don't mind giving up, but will then get the deal done because they're really important to the seller, that's how you get deals done. The next part is the contract phase. So before signing the contract, you want to check a few things. You want to have a look at the title and look into things like covenants, easements, council approvals, strata reports, etc. You want to have a look at the standard and special conditions of that contract. So the standard conditions are really different between different states. So you want to really understand how contracts work in different states. And the special conditions, honestly, are up to both parties. You have to pay attention to whether the seller has put any special conditions, or if you want to put any special conditions. Of course, the less amount of conditions you put and the more you're willing to accept the seller's conditions, you will have more leverage. Now, once you go under contract, you go into what's called the conditional phase, which building and pest and finance have to be finalized. For the building and pest, you must know who to hire for those inspections. You must know how to manage them, how to get the right answers from them and right information. You would also know how to read the building and pest reports and how to interpret them, and to know which things you can renegotiate with the seller and which things you can't. Then the last part would be the settlement. So right before settlement, you want to get a pre-settlement inspection done, and this usually is done by the same person that did that pre-purchase inspection for you, and that also has its own checklist and stuff. You would also want to manage your conveyancer. This is probably the moment where your conveyancer is going to be more active with all the paperwork to make sure everything is all good for settlement. And then the last step, once the property settles, you want to rent it out if it's not rented already. And for that, you'll have to manage your property manager. Now, as always, you can go ahead and take this and do it on your own, or you can leverage a team like ours that has gone through all the training already and has gone through thousands and thousands of hours of collective experience and trial and error to learn how to do this optimally.